Wow, there is an ascending triangle formation, and once the breakout happens, I will definitely buy. What the Has this ever happened to you? This is very common in breakout trading. Market triggers the breakout, grabs liquidity, then reverses its direction. Breakout traders always get upset by these fake breakouts because they only taught to buy above the breakout of resistance and sell below the breakdown of support. But in this video, you will learn something different. You will learn a powerful trading strategy to trade fake breakouts, and I will clear up all your doubt about these fake breakouts. So please don't skip any part and watch this video till the end. To learn how to trade fake breakouts, we will start with what fake breakout is and then why it happens, and finally the step-by-step guide to our strategy. So let's get started. See, in this, if the market bounces within the particular range like this is called the consolidation phase in the market. And if the market breaks upper side, it is called a breakout. And after this breakout, if the market goes to the consolidation phase again, it's basically called the fake breakout. And similarly, in case if the market breaks lower side, it is called the breakdown. So this breakdown, if the market goes to consolidation phase again, this is called the fake breakdown. Now let's go to the live chart and I will show you what I am trying to say. See, this is the consolidation phase in the market, this is the breakout in the market, and this is called the fake breakout in the market. And similarly, if we go to the breakdown case, see, this is the breakdown in the market and this is called the fake breakdown in the market. Now you understand what fake breakout is. Now let's go to why fake breakouts are there. See, trading is a zero-sum game. When one trader loses, another wins. And in case of fake breakout trading, it's usually the big players who profit while the retail traders get trapped and stopped out. If you want to have to start thinking like big players. And in this video, we will build the mindset like them. Let's see this chart. Right here, you will see two mindsets at work, the buyer's mindset and the seller mindset. If you are thinking like a buyer, you typically wait for a confirmed breakout above this resistance before you are entering. If you are thinking like a seller, you look to sell into the same resistance, especially when a strong red candle rejects at this level before and signal weaknesses. And direct sellers have little interest here because after this brief consolidation, a strong green candle pushes up, followed by a tiny red candle. Because that small red candle shows a weak rejection, many sellers choose to ignore the level and skip this, while only a few retailers take their sell right there at a resistance. But in this, buyer mindset are extremely active. Retail traders are eagerly waiting for this breakout and expect price to run high once the resistance breaks. But in case of big players like banks, institutions, hedge funds, etc., know this and they wait for the retailer crowd and the breakout because they want abundant buy orders. If we go to more technical term, they want more liquidity at that level. Once enough buyers have accumulated and the order flow matches their plan, they step in with the heavy size and heavy volume to maximize their profit. Some retailer traders call this is a smart money. You heard this sometimes in your trading journey, and this is true. Understanding this dynamic, retailer chase the breakout while smart money prepares around liquidity, helps you make the profit instead of getting trapped. Now you understand what is fake breakouts and why these fake breakouts occurs. And now let us go to our main strategy. Don't worry, this isn't difficult, but it does demand focus, attention and consistency in the market. We will keep it simple and break the process into three clear steps: trend, candle closing, and volume indicator. When a breakout goes against the trend, it's more likely to be a fake. In case of downtrend, an upside breaks into resistance often fails and return back. Similarly, in case of uptrend, a downside breaks into support usually is a fake. This is not 100% correct, but in most of the cases it is correct. Now let's jump to a live chart and see a quick example. In a downtrend, you will sometimes see a bullish structure like an ascending triangle, for example we take. Not always, but in many cases, the upside breaks is just a fake breakout. The pattern forms, price pokes above the resistance, then slips back into the range. Flip it around an uptrend, a bearish shape like a descending triangle can break down and then come back again to the support. See, in this, recognize when a bullish pattern appears in a bearish market or a bearish pattern appears in the bullish market. This demand confirmation before you commit. Let's go to our step 2 in this strategy, that is candle closing. Now we have checked that trend. Step 2 is a candle closing. After a breakout, if you see a strong green candle closing above the resistance or a green candle is formed at the support after retesting, keep this strategy because buyers have control and there is a good chance of continuation in the upper side. And if you want to know why this happens, see this video. this video clear all your doubts. But if price wicks above the resistance and then closes back below with a clear red candle, treat it as a potential fake breakout. That close backs inside the range is your first warning that smart money may have swift liquidity. Still don't hit sell yet. Wait for the final confirmation in the next step before taking the trade. If you want to catch the market's momentum, we need one more key confirmation. So let's bring in the volume indicator. I personally rely on two indicators, that is volume and the EMA. After this breakout, if you see a red candle with a heavy volume, that's a strong signal. It means there's a lot of money flowing in the market and the big players are stepping in. And similarly in case of strong green candle, if the strong heavy candles are formed opposite to their direction of breakouts, chances is that this is a fake breakout or a fake breakdown. Alright, let's quickly summarize what we have learned so far. To trade fake breakouts and move with the market, first look the overall trend. For example, if you are trading a fake breakout on the selling side, that is called breakdown. If you are trading a fake breakdown on the selling side, the market trend should be bearish and the pattern should be bullish. And if you are trading a breakout in the case of buying, the trend should be bullish and the pattern should be negative. And our next step is check whether the candle is closing below the resistance level or not. And our third step is finally confirm it with the volume indicator. If all the three conditions align, you are confidently enter the trade and place your stop loss just above the resistance level. No stress, no hesitation, just put your trade with proper stop loss and confidence. Now it's your turn, traders. Open your trading software and practice everything I've shown you today, because just watching videos isn't enough if you want to master this strategy. And I swear this strategy has so much good risk to reward ratio. So please practice this strategy and then apply on live market to earn profit. So let's wrap up this video, and if you want a video on any topic, just let me know in the comment section. And don't forget to like, share and subscribe to my channel. Your support motivates me to create more content and share even more trading knowledge with you. Bye traders, see you in the next video.